Hi guys, hope you guys are good, and welcome back to today's video, where we'll be doing a weekly outlook video on the indices to give us an understanding in terms of what we can anticipate in this week's worth of trading. So by indices, I mean US 500, US 100, as well as US 30. We will go a step further into US 30 into having to understand what we can anticipate in today's trading as well, because we are coming into the New York session as well, right? Another thing I'll be doing in today's video is I'll be going through a few ICT concepts. As I break down the markets, we'll be looking into those concepts as to give you guys more of an understanding of why price was expected to go to a certain point and why, and why and how to use that certain concept, right? One of those concepts will be smart money divergence, right? I did post this study or analysis of correlated assets last week, and I got a few questions on my TradingView DMs, right? Just people trying to understand how to exactly use it and how to use it when it comes to the market, right? In real market conditions, right? So we'll be going through all of that. And in fact, what I'll be doing is I'll be taking those concepts and I'll be showing you exactly how to use it within the markets themselves, right? Because what SMT does is it essentially gives you an understanding of whether your idea, let's say if you're looking for a sell idea, it gives you an understanding of whether that idea is in a high probability trading environment or is it in a low probability trading environment, right? So we will be going through all of that, right? So if you happen to find the information shared in today's video valuable for you guys on YouTube, I'd appreciate it if you'd subscribe to my YouTube channel. I'd also appreciate it if you'd follow me on my TradingView profile as well, due to the fact that I do release my day-to-day analysis, right, in terms of what I'm anticipating on that specific day, right? So I am a day trader myself, so I happen to post on a day-to-day basis in terms of what I'm anticipating to trade, right? Or what I am seeing, right? But with that being said, what we'll firstly do is we'll just go into last week's trading on US 30, right? To give us a brief as to why I was anticipating price having to reach into this bearish order block. And then what is our next move in this week's worth of trading, right? So last week on well, it wasn't the 6th, this was updated on the 6th, but last week on the 4th, yes, on the 4th, I posted this analysis on, having to see this temporary bullish move as they reach into this bearish order block over here. And the most important objectives were these bullish, firstly, this H1 buy stops, and then that bearish order block. So you'll see that on my trading view as well, I post everything from my analysis, my entries, and all of those sorts of things, explaining what I was seeing on that specific day. And the reason for this is because I use my trading view as my journal. So these are all of my entries in terms of what I was anticipating, my trading, and all of those sorts of things, right? So even my losses, you'll see most of my ideas have my losses and stuff like that, as well as an entry in terms of um, what happened or what I'm anticipating and all of those sorts of things, right? So in this journal entry, I was looking to see a potential buy opportunity into this bearish order block over here. And what was happening in price is we got a market structure shift here. We got a heavy bullish movement of price towards the upside, a retracement into discount price action, right? And why was I anticipating a bullish move towards the upside? The reason for that was because of this liquidity void. Now, what you need to understand is how smart money moves within the market is there's only two things that the market is trying to do, which is smart money is trying to enter the market, order pair, right? And in order to order pair, they need to do so against liquidity, right? And the other thing they need to do is they need to book their profits, right? And where they book their profits are in areas of fair value, which are areas of inefficiencies. So fair value gaps, liquidity voids, all of those sorts of areas are good areas for smart money to look to book their profits, right? So you'll see here, price moved into discount prices where we come into this bullish fair value gap over here. It's in a discount price, so smart money will look to add positions or accumulate long positions over here. We can see that buy stops are taken, price moves into internal range liquidity. I've spoken of or through this idea of how the market tends to move. After external range liquidity is taken, the market will draw into internal range liquidity, right? If you haven't seen that, I will attach a video into having to explain how essentially the market tends to move. So once these buy stops are taken, external range liquidity being the highs, right, the market will draw into internal range liquidity, be it fair value gaps, order blocks, all of those sorts of things, right? So we can see how price was respecting these discount arrays. Smart money is continuously accumulating long orders. I was having to see this bullish fair value gap hold and having to see price continue towards the upside. My first objective, of course, was these buy stops. And then, of course, the second objective was that bearish order block. So we can see as well, I do post my entry and all of those sorts of things. So this was this idea, this bullish move towards the upside. And for me, all I look to target is 4% a day. I only trade the afternoon session when it comes to, uh, I only trade the New York session when it comes to indices, right? So this is an entry as well, journal entry on the 5th of June. We can see that the first objective was met, but we still have that liquidity void. One thing you need to understand, if the liquidity void has not been filled, continuously look to trade in that direction, right? So after these buy stops were taken, which is regarded as external range liquidity, there's a possibility that price was going to look to draw into internal range liquidity. So I was still anticipating that further move of price into the second objective over there, right? So we can see after external range liquidity is taken, price drew into internal range liquidity, where it drew into this bullish order block, as well as price took these sell stops, right? As well, right? So we can see that from the leg, this point, in fact, or that point over there till that point over there, price basically drew into discount prices, which is an area of fair value for smart money to look to accumulate new long positions, right? So I was anticipating price having to continue that movement of price towards the upside. So this bullish order block is also strong due to the fact that it has sell stops right above it. It's considered as an inducement order block due to the fact that it has those sell stops right above it, right? So we understand once these sell stops are taken, the market will move in the opposite direction. If price was going to continue the narrative of having to continue towards the downside, we can see that we have a fair value gap over here, right? From that candle's low to this candle's high, right? If price was going to look to continue towards the downside, that fair value gap would have you would have wanted to see price respect that. But we can see this candle over here breaks through that fair value gap, right? Which gives us an idea that price is going to continue towards the upside due to the fact that once that fair value gap is broken, the fair value gap becomes an inverse fair value gap, and you're looking for price to support it. And that fair value gap as well was aligned with this bullish fair value gap here as well. So I was looking for that idea of having to see price continue towards the upside. So this was the trade itself. That's that fair value gap over here. When it comes to entries and all of those sorts of things, I use my 1 minute as well as my 2 minute, right? So I can see price starts to give us a market structure shift over here, indicating that the smaller time frames in terms of institutional order flow is going to look to be bullish, right? So we get the market structure shift, price pulls back into a reclaimed order block over there, which is a nice area of institutional support zone, right? We have this was probably a 5 minute fair value gap. Price respects that. We get displacement towards the upside, market structure shift, price respects this, pulls back into that mitigation block aligned with that bullish order block over there. That line over there is a 1 minute fair value gap, right? So I entered off of this region, SL on the low, only look to target 4%, right? And then, yeah, eventually we reach our objective. Remember, the objective, most important objective, was this bearish order block due to the fact that we had that inefficiency, that liquidity void. So the market had to fill that. Now we understand that smart money has, they have they've basically have scaled out all of those long positions that they had continuously being entered, right? They continuously have been entering, right? They've scaled out those long positions. Now there's no need for price to continue further towards the upside. If it continues further as to break this region, then we might anticipate more bullish institutional order flow, right? But as long as this region is being respected, price will look to continue towards the downside, right? We are at an area of fair value for smart money to look to push towards the downside. Now, why would it look to do that, right? We can see that down here we have this trend line in which smart money basically developed or engineered trend line liquidity. How did it do so? We understand that at these lows, there are investments that are, sitting there below these lows regarded as stop losses, right? Or sell stops. We understand that retail traders were continuously buying this. Their stop losses are at these lows. Now, smart money, like I said, will look to do two things. It's always looking to draw towards liquidity, right? So that it can order pair against that liquidity or book against that liquidity, right? So that's why smart money at times will engineer liquidity, either to order pair. And what I mean by engineer liquidity as well, look at this region over here. We have two areas that were basically regarded as engineered liquidity. If you're looking at this region over here, you can see that there's a resistance zone over here, right? Now, smart money will intentionally engineer this resistance zone. How does it do so? Understand that they have the liquidity to hedge the market. The market reached here, they sold this area, the market pushed lower, pushed this high, they sold, buy, sold. So that's what makes the market move. Their orders, because they are the liquidity provider. We are not the liquidity provider as retail traders, right? Now, why do they engineer liquidity? They make this resistance zone, right? And they continuously sell it as well because we sell this resistance zone. Us support and resistance traders will look to sell this. And what does that do? At these highs, that's where our stop losses exist. Those are considered as investments for smart money because they'll enter buy order over here, rapid movement towards the upside. It will absorb all of those stop losses, which are regarded as buy stops, right? These buy stops are essentially willing buyers. They've turned us retail traders who are consistently selling this. They've turned us into willing buyers to sell against. So now they have liquidity to sell against. So that's why they do that. That's why they consistently hedge the market. They formulate these retail patterns. We trade them. Now, where's the next objective? There's strong likelihood that they'll look to absorb all of this liquidity over here. Nice liquidity for them to target, right? In which that's what we're also interested in, right? Most of us are ICT traders. That's what we look to, you know, push the market to. That's what we look to trade towards, right? Because we understand that smart money is looking to do the same thing. So we understand once price engineers liquidity like this, we don't sell the market here. Instead, we buy against all of this liquidity because of that liquidity void over there, right? Cool. So the next objective is to see price continue towards the downside, right? Now, that was last week's trading coming into this week's trading, right? And we understand that the objective on US 30 is we're looking to sell, right? Towards the downside, right? And of course, this was I released this pre NFP last week. And then, of course, we can see price relatively equal highs, engineers liquidity, smart money absorbs it using the NFP, and then the real direction is towards the downside. We are in premium prices, so these are this fair value, not the fair value gap, but the bearish order block is at a nice area to sell, right? We understand we want to be selling at a premium and taking profits in discount prices, right? So that's our drawn liquidity, which is towards the downside, which is these sell stops over here, right? So we have a narrative as to what we're going to be seeing on US 30, right? But we'll get back into that. So now we want to understand what are we seeing in all three of these assets, right? And this is where we come into analyzing or studying correlated assets, being US 500, US 100, US 30. This is where we go into smart money technique or smart money divergence. So I've done this before, a lecture on smart money divergence before. I will attach a link into that into so that you guys further get a understanding in terms of how it works and how to go about using it, right? But I'll touch on exactly that. So when it comes to SMT, right, or smart money divergence, what you want to do is you want to understand that it is the study and analysis of correlated assets or the relationship to inversely correlated assets, right? An example of correlated assets is when you're looking at the DXY and you're comparing it to GBP/USD, or comparing it to whatever pair that has the dollar within it, right? That's a correlated asset, right? They have a relationship. So you can use smart money divergence into having to understand how exactly what can you anticipate within those assets, right? So how smart money divergence works is we're looking at all of these assets. We understand that they have an 80 to 90% correlation. So they move exactly the same 90 or 80% of the time. So we want to see what happens when price does not move the same. What does that mean? If they have an 80% correlation, what does it mean when they don't have that correlation anymore? And all you want to see is one of them. You don't want any one of these um, indices, right? So looking at these separately, we understand this is US 500. We understand we have these relatively equal highs over here. The market pushed higher and took out external range liquidity. Now, independently, we understand that US 500 is going to look to draw towards internal range liquidity, right? But we have an idea of that, right? How do we confirm that, right? So we have that idea. US 500 is going to be looking to draw towards internal range liquidity. Same thing goes with US 100, NASDAQ, right? Relatively equal highs, strong amounts or large amounts of liquidity exist up there. They push the market higher, takes out external range liquidity. They're looking to sell, they're distributing at this point. They'd likely distribute into areas of fair value or internal range liquidity, right? So we have an idea independently. We're looking at US 100. We can see that there's an idea that price might draw into those areas over there, right? Now, let's look at US 30. It's the same chart, right? Look at this area over here, this high, right? It's exactly the same all the way up, right? If they have a 80% correlation, why is it that US 30 didn't go all the way up there and absorb all of that liquidity or take out that external range liquidity if they have a 80 to 90% correlation? Now, the only way that can occur is if smart money is continuously distributing. To distribute is to sell. The only way this divergence can occur is if smart money is distributing orders within the market, right? And the reason for that is because smart money is the only entity that has the liquidity to do such a thing, right? So this gives you an idea that the moment you start to see over here a non-symmetrical market idea, we understand that these two are symmetrically trading, right? They both made higher highs, right? Whereas this one did not make a higher high, it made a higher low. Once you start to see a non-symmetrical correlation, this indicates a reversal in price. So immediately, it only takes one of these, right? The moment you start to see that idea in only one of these, that divergence, then automatically you should have an understanding that you can anticipate a reversal. So already buy stops were taken here. We anticipated price to continue into internal range liquidity. Now, because of this divergence in price, already you have an idea that you can anticipate a reversal in price, which makes sense. Now, that idea becomes more high probability. You understand? Whereas if all of these pairs were exactly the same, right, and US 30 made a higher high, that would be a symmetrical correlation, which would indicate a continuation in price towards the upside, which would essentially mean what? Don't look for reversal patterns if the market is going to be looking to continue towards the upside, because that would be in a low probability trading environment. Whereas in this instance, you can look for reversal patterns in these areas, right? In all three of them, because price is suggesting that you can anticipate a reversal in price, right? So that's essentially smart money technique, right? Now, with that being said, we're going to be looking at US 30, right? We have an idea in terms of what we can anticipate in all of these assets throughout the week. We're looking for bearishness within the market, right? Now let's look into US 30 in terms of what we can anticipate in today's trading, right? We already went through the idea of having to see price draw all the way down here. We have these sell stops. That is my draw in this week's worth of trading. We also have these relatively equal lows over here, which is a nice area where liquidity exists, right? So we can also look to see the market draw into that area in this week's worth of trading, right? So what I want to take you guys through is into having to understand what we can anticipate in today's trading, or the likelihood or potential of what we can anticipate, right? So we hit our bearish order block over there. We're anticipating price to continue towards the downside, right? So the first thing we're going to look for is fair value gaps, right? I did a video as well on fair value gaps when I was analyzing gold. I will attach that video over here where I spoke through fair value gap theory, right? And in which you just want to understand where is the inefficiency, how to correctly mark your fair value gaps. The first thing you need to do is establish what is the market doing. From this point over here towards the downside, we understand that the market has been selling. So it's in a selling environment, right? Now, you want to look for the inefficiency, right? If the market is in a selling environment, you want to look to see where is the area where there's a buy side inefficiency in price, right? So we can see this is a sell side movement in price. All of this has been efficiently traded due to the fact that buy side, for the market to push towards the downside over here, the market had to also buy towards the upside, right? So we understand buy side was traded, or buy side was introduced within the market. So all the way from that high till this area over here, buy side was efficiently delivered. Both buy side and sell side was efficiently delivered. Once price reaches this point over here, we understand for price to establish that low and then push towards the upside, buy side was introduced into the market, right? So we understand that this area over here is the last point where buy side was introduced, and then we had this bearish candle towards the downside. We had buy side introduced over there, buy side, and then this candle also brought about introducing buy side liquidity. Now, the difference between the buy side liquidity being, or the buy side movement being introduced over there and the buy side being introduced over there, the difference between these areas is what will be our inefficiency, being that fair value gap over there, right? So we understand that this is our fair value gap, and everything that exists all the way up there has been efficiently traded through. The only thing that has not been efficiently traded through is this fair value gap over here. So we can look for price to having to fill this fair value gap and then establish a POI, look for an idea to continue the market towards the downside. And you already know where our objectives are. We already have sell stops existing all the way down there. And then continuously we have that engineered liquidity, our daily sell stops all the way down there, right? So we have established that everything that exists up there has been efficiently traded through. This is the only area which is inefficient, right? Now let's go into our M15 time frame. We're going to add more confluence to that idea, right? Here we go again. Everything that exists up here has been efficiently traded, right? So we have established efficiency all the way up there. Efficient price action on the M15. What do we see? That's the last point. Buy side was introduced. This is the last point. Buy side was introduced. What's that? Fair value gap. So we'd like to see price fill that, right? So that's our fair value gaps. Now, here's another thing as well. What exists between this last point where buy side was introduced? We see these green candles pushing towards the upside. Where's the other last green candle which was introduced? That point over there. So that's how I mark my liquidity voids. You can see that price tried to fill that liquidity void a bit over there. I don't know what color to make that. That's our liquidity void. Price tried to fill it, but we still have that inefficiency. Now, same thing with price, what we studied with that bearish order block over there. We want to see price completely fill that area, right? We want to see price completely fill the inefficiency to give us an idea to continue price towards the downside. So this is not my POI. This just gives me more confluence for price having to fill that. What does this exist as? This exists as buy stops. So they are already willing buyers to sell against when the market gets over there, right? So this is my first POI where I'll look to sell the market. So that's my first POI. Another area as well, this exists over here as buy stops. So there's still a likelihood of price having to push all the way up here and take the buy stops, right? And then continue towards the downside. I only look for two POIs, which are high probability because I only risk 2% per day, right? So that is our bearish order block over there. That is my first POI. Large amount of confluence right over here that the market might reach into that, and I'll look to sell the market and continue the idea towards the downside, right? So that's where I have my, that's where I have my alert over there. And then another thing you can do, once price reaches into this point, you can now add SMT, the same concept we went through. You can add that into having to understand, is price over here going to print a reversal pattern, you'll see it, or a continuation pattern. If it's a continuation pattern, then it will be a low probability environment. But if it's a reversal pattern, being US 30 and US 100 is not symmetrically trading, then you can anticipate a reversal. So over here, you can see we've taken that. If US 100 and US 30 gives you that idea, reversal pattern, let me give you an example of what I'm trying to say. We can see over here, price in last week Friday's trading, price reached into our bearish order block. Price broke this low over here, giving us a change in state of direction. So we have a idea that that is our bearish order blocks, right? So we'd want to see this bearish order block hold, right? Now, as far as trading this, you want to add more confluence to the idea that price is going to look to push towards the downside. How do you do that? You compare your US 30 to your US 100, right? Now you want to note this high, right? And then that high over there. And the cool thing about this is there's no lagging factor to it due to the fact that these are both markets, right? So there's no lagging factor into SMT. It's an indicator, but there's no lagging factor, right? You're just analyzing price. What does this idea give you? This is a non-symmetrical market condition, right? Non-symmetrical market condition means anticipate a reversal. So already when price hits this, you could look to sell that, SL on the high, look to anticipate price to continue towards the downside. Same thing on NASDAQ. Look for selling orders. Price has taken buy stops. Look to anticipate price having to continue towards the downside. So add that confluence into this idea once price reaches into this area of importance over here, right? And then potentially you may catch a trade off of that, right? But as far as that's concerned, those are my PRIs in today's trading. I'm not saying that they're going to be, you know, work out. There's also a likelihood just because it's a high probability trade doesn't necessarily mean that it's going to go well, right? So analyze the market, try and find the narrative of the market, and then, yeah, just go off of that. But if you guys do have a few questions, please do leave them in the comment section. And I really hope um, what I tried to convey to you guys today was, that you got an understanding of what I was trying to convey, right? But yeah, with that being said, uh, best regards, the architect.